Welcome to the How Did They Do It Real Estate podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal.
Thank you everyone for joining today's episode of How Did They Do It Real Estate Podcast. I am your host, Sayla Prack. Today, I am very honored to have our special guest, Lane Kawaoka. Lane now owns over 10,000 plus rental units worth $2.1 billion of value and share the simple methods and tactical steps to build a passive real estate portfolio on the side of your busy day job and business. Lane is also a writer for Forbes Top 50 Investing Podcasts and Amazon bestseller. He also the owners of crowdfundaloha.com, simplepassivecashflow.com, and reialoha.com. Lane is responsible for finding investment opportunities, analysis, and marketing, and working with the investors and making sure that helping you building your passive income as well. So, Lane, it's a great honor to have you join us the call today and coming to talk to me on our podcast. How are you doing today?
Hey, good. It's a little early here in Hawaii, but I try not to wake up super early now that without the day job. But yeah, really glad to able to speak to everybody today.
Thank you so much, Lance. And can you tell us a little bit more about your background and how did you get started with real estate to begin with?
Yeah, certainly. So I started, I think like a lot of investors got grown up in a family where, I was kind of groomed to go to college and get a good job and work at that job for 30, 40 years. My family was also very frugal. We always saved our money. We rarely ate out. And when we did, we never bought soft drinks. That's a waste of money. We just buy water or get tap water. Just a few things of many, just that frugal lifestyle. But yeah, I started off as an engineer going through college. I wanted to get paid the most money without having to get a master's degree or doctorate. So I started to work. And again, on this I call it the linear path. We're all taught to go to school, study hard, and then buy a house to live in. And that's what I did. I never questioned it. I mean, why, right? My parents did it and they turned out all right. Granted, they invested in the 401k, traditional investment stuff. And looking back, boy, did that hamper their financial growth. But like I said, I bought that house to live in. And because I was traveling all over for work at the time, as most young professionals are, I was in construction management and I was never home. And I just kind of got the idea to just rent it out. This is back in like 2009. Well before Turo, but I just kind of thought it was a little silly that me, a young guy in my 20s, owning this big house to be living there just on Saturdays. So I rented it out, and that's where this all started. I get that taste of cash flow. This was in Seattle, Washington. The rents were, I think, $2,300. The mortgage was $1,600. I knew nothing about rent to value ratios, the 50% rule, any of that. I just saw like several $100,000s of passive cash flow every month. And for a young 20-something-year-old back then, that was a lot of beer money. But, that just, after like 3 or 4 months, I was like, well, wait a minute. If I kept doing this over and over and over again, I'll be able to quit this day job that I wasn't particularly fond of. And just started to grow the portfolio from there.
Oh, that's amazing. It's like you mentioned that's a lot of beer money right there. But instead of like, oh, this is the money that I can just use and spend on other things, you decided to grow your portfolio. And can you tell us a little bit more from there? So how did you get into multifamilies and other rentals and all that as well?
Yeah, I mean, it took a while, right? Because I started from like zero net worth. I had to pay off a little student loans too. So that was 2009, started to rent it out. And then, I got that idea of, hey, I need to buy more rental properties. And I bought a duplex in Seattle, Washington. And a couple of years later, I think it took me, maybe a couple of years to save up the money. And I didn't realize that you want to invest money outside of your local area, especially if you live in California, Hawaii, Seattle. The rent to value ratios just don't work. And I really discovered that in 2012 because the prices of properties kept going up and up and up, and I wasn't able to cash flow, and I was like, what the heck? Maybe my investment career is over. And then I started to find these turnkey rental properties, back then, and I guess still now, there's these turnkey rental vendors that will rehab a property, new plumbing, new appliances, and then some of these guys will even put a tenant in there for you. And lazy investor like myself, who's busy being an engineer, can just buy a property, $100,000 that rents for $1,000. So I did that in Birmingham in 2000, and I think this is 2012, 2013. It was after I bought that Seattle rental property, and the dang thing worked. And I was like, whoa, I can run this remotely with a property manager. So I had a lot of equity built up and appreciation in the Seattle rental. So I sold those two, did 1031 exchanges on both of them. And in one year, I picked up like 9 more rentals out of those two. Fast forward to 2015, I had 11 of these rental properties. I think 5 in Atlanta, 4 in Birmingham, and 1 in Pennsylvania and 1 in Indianapolis. I was going to buy more, but I hit that ceiling of 10 Fannie Mae Freddie Mac loans. And I also started to feel the pain of evictions, and it just was starting to become a job. If anybody wants to know what it feels like to have, 10 rental properties or 11 rental properties, it's cool. You're getting like a few $1,000s of passive cash flow a month. Nobody's quitting their job over that, however, so you need more. But as far as like workload or headaches goes, I had maybe an eviction or 2 every year, some kind of big catastrophe that happened every quarter, like a tree falling in the house or like a washout in the basement or something. No problem. I had the property manager to deal with all that nonsense. But if I needed a 10,000 or today, a lot of, my clients, they're looking for $15,000, $25,000 passive a month. You're talking like 30, 40 plus houses, and you have to just multiply that exception rate by 3. So now you're talking about an eviction every other month and some kind of big catastrophe every other week. And I'll say like during that period, that short period, I maybe had 6 or 9 evictions, and I had 1 or 2 big incidences of a tenant just trashing the house as they left. And it just really makes you lose faith in humanity when that happens, and like totally blows your performance out of the waters. When you have to pay like a $10,000, $15,000 repair bill. And I was like, yeah, this isn't all cracked up to what it's supposed to be. And at the same time, I was starting to meet other accredited investors once, because up to this point, I stuck to myself because I'm an introvert and I don't like to talk to other people. Things have changed back then. I love talking to investors about, investing in alternative assets, obviously today. But back then, I was kind of a lot more introverted, but I started to meet other accredited investors, and I get excited over investing because it's financial freedom, getting out of the day job that doesn't really thrill me. And they were all dumping their rental properties and moving into, the multifamily syndications. And, that was kind of around 2015 when I started 2016 when I started, kind of grow and take that next leap.
Wow, that's amazing journeys. And thank you so much for sharing all that information.
It took a while.
It took a while.
Yeah. Sorry.
But you also mentioned about the rent to ratio, right? Or rent to value ratio. And you invested in quite a number of market. Do you recommend right now how is someone who just wanted to get started, like a busy professional or working full time and wanted to start building up the portfolios or passive income? Do you recommend them to, where do you recommend to invest in a primary market or secondary market or tertiary market? What's your thought on that?
Well, I mean, we invest in primarily secondary markets. we try to stay away from tertiary markets because a lot of times it's just not a really robust economic employers in the area.
Mm-hmm.
That said, we like the red states, obviously, because landlord friendly laws on our side. But I think overall it's all about like rent growth. And those are typically in the red states. And like you said, you know, the rent to value ratios is one way you can measure it. You know, how much rents are you getting for your bang for your buck, basically. And, you know, that's important because, you know, real estate, it'll appreciate. And especially if you're in the forced appreciation game of rehabbing units, you're going to get that. But, you know, you never know when the market takes a dip, like, you know, how things have kind of gone down 10 to 15% across the board. At those times, times like now, you kind of just chalk it up to like that cash flow, that little buffer that you have is so precious because it allows you to pay your debt service with little care and worry that, you know, you have to lose the property, right? It's the difference between the house flipper mentality and the buy and hold mentality. It's kind of the best of both worlds when you can rehab, but also cash flow on the property.
So as of today, Lane, you started with the multifamily side of things. And are you invested in what type of asset class are you investing in right now for the multifamily? Is it a class A, class B, class C?
Yeah, I mean, I still go off the thesis of like workforce housing, right? Like I don't like luxury type of stuff because it kind of caters to the class A. I like to go for like the lower middle class workforce housing still, because that is the glut of the American population. And the way I see things, the rich are getting richer and the poor, and also the middle class is shrinking, becoming the lower middle class. That said, you know, we started with a lot of class C properties because they are cheaper. They're more accessible to newer operators. Over the years, we kind of stepped into more class B assets because boy, are the class C assets a pain in the butt to manage because the tenants are just like, man, like some of the properties we had, like in the good times, like delinquency was like 20%. So that means like, you know, only 80% of your people are paying. And that's considered okay. And like, it's just like, man, that's not like kind of the clientele I want to be in. You know, it's by no means is it like class D, class F war zone properties, but like, you know, in some of these we had to get short term, like run a cop out there to kind of keep the peace at the property. Then we started to step up to like the class B properties. Like I said, a little bit better clientele, but still not the safest places at night, you know, totally fine in the daytime. And then bigger properties, but still you get people run into problems, right? And a lot of these tenants in the class B and maybe even the class B plus A minus, they don't have that much savings. Something happens, their car breaks down, you know, they don't pay their rent. And that was kind of where we started to look around and multifamily syndicators, operators, what do they do once they've been around and more than 10 years? Or and even as a passive investor, I asked the question, you know, for my passive investor money, maybe I'd like to put it with somebody who's been around before the 2008 recession. The truth is nobody's really out there. If they are, they become very institutionalized and their returns aren't very good. Mm-hmm. Putting back my operator hat on, you know, we've done over $2.1 billion of assets, 10,000 units. I like to think that we're kind of past the infancy stage being an operator. And I also think like for us, like we've already proven ourselves on the development end, you know, taking something ground up, which is the ultimate value add. There's just what I've also seen is like other operators who've been around much longer than us, what they typically will do is either become institutional where, you know, most of the people listening probably doesn't want to invest with them. You know, you're looking to double your money in 5 years. It's double your money in 10 or maybe in 15 at that point. Much more overhead, higher fees, worse investor splits. but they're reliable, I suppose. For some of my investors that are a net worth of $4 or $5 million plus, do recommend some of those institutional operators. But for most guys, where I was back then, you need to work with a reputable operator, but somebody who's not on the institutional level, giving you good returns and splits and good fee structures. So today, what we've kind of done is, we're not really doing multifamily value add deals right now, at least temporarily, because the interest rates just aren't advantageous to do it.
Right.
Like, I just can't make a deal work at 7%.
Right.
And I don't want to go get a floating rate debt, especially in this increasing interest rate period or quantitative tightening. So we actually cut that off summer or Q3, Q4, certainly Q4 of 2022. We stopped doing multifamily value add deals and we just kind of focused on the portfolio. As far as new acquisitions, we kind of ramped up our development side, which doesn't really impacted by interest rates, because with development, you have your construction loan, but you don't pay money until you take the draw on it, right? So if you have a $40 million construction, the first draw may be only $5 million and you're paying interest on that. And then of course you wrap up from there. So really the amount of money, the average loan, if you want to look at it like that, is like half. And you're not paying the interest right away. That's kind of indicative of a construction loan. And the margins are so much bigger because you get rewarded. Wealth comes to those who create value. You can create value by putting a little lipstick on a pig on a multifamily apartment, new flooring, new appliances, new paint job, $5,000, $10,000 per unit, and bump the rents up incrementally and increase the NOI ever so slightly. Or you can take a raw piece of land, build a brand new Class A unit that's like 30, 40 years newer than somebody buying a Class B asset for almost the same price you're building it for. That delta in terms of net operating income increase is so much wider, and there's so much room for error. On the other side of the equation, we're also kind of focusing on preferred equity, because right now a lot of people can't get lending. So we're kind of filling that void as the bank. And then that kind of helps our investors get like that monthly cash flow piece. Because the downside of multifamily apartments and especially developments is you have to wait till the property is built. And it can take a year or two before the asset is built for it to be refinanced and then start cash flowing for investors. So that's kind of how we've moved on kind of today. Maybe in the next year or two, when interest rates come back to earth, or more importantly, restabilize, so the rate caps aren't as expensive, maybe we come back to multifamily value add. But that's kind of where we're at today in this market.
And also, Lance, as of today's market, and someone who wanted to start investing in apartment syndication, or like creating cash flow, what are some of the things on the deck that they look at? What are some of the key things that you recommend that they look at in making sure that this deal is a good deal and a realistic deal before they start investing in or jumping into their first apartment syndication?
Yeah, I mean, it's hard for passive investors, to be honest, because a lot of times what's on the deck is not really useful. You've got like half of it talking about the market. It's all just fluff thrown in there from the broker's deck. You as an investor should know the top markets, top emerging markets. You may not know where, take like Houston, Texas, for example. There are like a few dozen different submarkets within Houston, Texas. Houston, Texas is a huge market too. You as a passive investor probably don't know what are the good submarkets, but perhaps you know which quadrant of the map is the growth. I think you need to know at least that. Like for example, like Atlanta. Atlanta, the growth is to the north, kind of like a martini glass, right? You stay away from the south and the bottom left, the bottom right, but the growth is to the north. Kind of similar like Dallas, but as a passive investor, I think you need to know that at the very least. Or Heck, you maybe you don't even need to know that, but you need to know at least, hey, like the top 5 markets or the states, Arizona, Texas, Florida, Alabama, just that,
Mhm.
right? As far as like when you do get the pitch deck, what if you're given the information? I would look at the reversion cap rate. What is the sponsor using to underwrite the deal conservatively? That pro forma numbers, I think what most investors will flip to. What is it that they're getting in terms of, if I put my money in, what am I getting? Or like, what if I put 100 grand in, what is my pro forma returns? That is what most investors will go to. And I think that's the wrong way to do it. Yeah, you check for it and make sure it's within the range of everybody else. But what you want to check are like the reversion cap rate, because if you tinker with the reversion cap rate, your rate increases drastic, your pro forma returns drastically decrease or increase. An example would be, it's kind of common practice if a property is like a 4.5 cap, for example, that you want to use a reversion cap rate of 1% or higher, because you want to assume that you're selling it into a softer, worse market, right? You want to be conservative. So common practice would be, that reversion cap rate being 1% higher or 5.5%. But maybe the sponsor is cutting corners and using 5%. Well, and they're getting 100% return in 5 years. Well, I know enough to know that I play around the numbers. I have the model. So normally, like if you're fudging the reversion cap rate like 0.5%, that could be like 30-40%. So really that deal isn't as great. It's if you underwrite it with the right reversion cap rate, it's really like a 60% return on 5-year deal. And that totally changes the picture. The second big knob that people can screw around with the spreadsheet is the rent increases per year. Most places today, the common practice, even in a good market, would be using a 2% rent increase, or they call these escalators in construction, right? Like when I was an engineer, we, especially because I work for the government and everything takes forever and everything's long range plans. If we're going to buy like bridge trusses to build a bridge 5 years later, we need to assume that, due to inflation, that, think the price is going to go up 2%, 3% every single year. Now, in that case, I might use 3% to be more conservative. But in when you're looking at deals, you want to be a little bit more conservative with the rent increases. And you're probably looking more for like a 2% rent escalator. Now, if somebody is fudging the numbers and weaker market especially and using 3%, that's a huge red flag. You see all those bigger pocket like analyzers that people have that they just go on the website. A lot of those guys will use like 5%, which is kind of absurd in my opinion. But those are the things you need to look out for. And then also like, what is the full occupancy assumption? The property ain't going to go 95% occupied. Might be 90, 92%, but and maybe you should probably use that. But on top of that, you also want to assume for like a few percent at the very least of vacancy or economic vacancy, which means the property may be filled at 95%, but if 5% of people are not paying, they're just deadbeats, then your economic occupancy is really 90%. It's like, what are you actually collecting of the rents? There's a whole bunch more, but as far as like 80-20, I'm a big 80-20 guy. That's how I kind of teach my folks. Is like let's just focus on the big things. What I kind of teach my folks is like go into deals where you don't get your money stolen, learn these tax strategies, real estate professional status, maybe do some conservation easements, and then infinite banking. We also kind of do that. There's a lot of other strategies, but like you focus on those 3 for now, and you're good. That's like the 80-20. That's kind of how I look at like passive investors from a practical sense, looking at these pitch decks. Other than that, you don't have the information. I mean, you don't have the P&Ls, you don't have the rent rolls. That's kind of out of the scope of passive investors. And I think what we're getting to is like at some point, the more important thing is talking to other pure passive accredited investors. Talking to the real estate syndicator sponsor, is kind of a waste of time, in my opinion, because they're just a sales guy. They're going to tell you everything you want to hear. What you really need to do as a passive investor is build your network with other purely passive investors. The problem is, where do you find them? Because the local real estate club are just a bunch of low net worth, non-accredited investors flipping houses, and they don't have money. And, there's a lot of other like multifamily meetups, and, they're just other real estate sponsors putting it together to get you to invest with them. And there's just too many non-accredited, like, you're looking for purely passive accredited investors, and it's really hard to find, put it that way. But yeah, that was a bunch.
Yeah.
And I think your earlier question, you mentioned like what other asset classes. I've invested in mobile home parks. Not a huge fan of that because that requires you to also sell the damn houses. So you're almost like a car dealership to realize, your full returns. So I'm not a huge fan of that. And it's kind of lower class C, self-storage. I'm not, I hear it's good. I've done it a little bit. I've done some bulk storage, but as far as an operator, because I'm an operator, I have to kind of focus on my core business. Passive investors, I feel like can spread it around and, enjoy the Las Vegas buffet, have some Chinese food, pizza, Italian, dessert. They can go into all different things. But one thing I see, or at least I see a lot of my folks doing that may be a little wrong is like, when you get into this world, you read the Rich Dad, Poor Dad book and you realize you can get into all these alternative investments that, they make a lot of sense, right? Like workforce housing, get into stuff that like cash flows from the start and growing demand and limiting supply in the future. It does make a lot of sense. And I think people like plunge into like just diving off the deep end and just diving it all up into all these different asset classes. And I would say I would caution against I'm going to get me 3 apartments, 2 mobile home parks, and then 2 self-storage and 2 shopping centers. I would generally advise against that. I would say focus more on one. You are a brand new passive investor. You do not, until you really understand the asset classes, don't go into them. And there's really no need to diversify in all the typical asset classes alternative investors do. Just start off with a little bit in 1, maybe 2 asset classes first. And apartments is usually the first one because a lot of us have lived in apartments, or we send our kids to live in apartments. So we kind of understand the business, or we were renters at one time of a house. So we kind of understand the mentality and the business. Whereas, maybe you haven't use a self-storage locker or certainly to that scale, or certainly many of us have not lived in mobile home parks. I didn't live in no mobile home park. But that's kind of another tip, don't spread yourself too thin, at least get your stuff ingrained. And then, maybe I'm kind of pitching apartments because, I'm in apartment land. That's kind of where I operated. But what I would say is get ingrained there and meet other passive investors. And then from there, have them be your conduit, right? Meet other people, build organic relationships. I'm big on that. I do a lot of events where, it's purely passive investors. And from there, you meet people and then you see, what mobile home park sponsor are you working with or have you had success with? And as opposed to being the first man in, first man in is first man down normally, right? He takes the bullets, right?
Yep, I agree. Yeah, get to know the sponsors and, of course, talking to other passive investors and get their feedback and, get their experience, and especially those that invested in a sponsor for many years. I'm pretty sure, and they have a lot to say about certain sponsors. So, Lance, also, you mentioned a lot of our busy professionals, they working, right? A lot of them, their liquidities are kind of stuck in their 401k. Do you have any recommendation of how they can use that money to invest in real estate, or how does that work?
I mean, for most people, when I kind of break down their situation, and it is different for everybody, for most people, it's kind of 2 things. And most people should pull their retirement funds. I mean, of course, you don't want to take the money and blow it on, things to play on. Obviously, you're going to invest it and it is going to stay a retirement plan. but it's not going to be the government sponsored kind of qualified retirement plan money for many reasons. I guess, well, maybe we'll go through those reasons first. Well, first, you want to pay taxes on it today because your tax bracket is likely lower today, right? In the future, you're probably going to make more money because you're a good investor. You're going to make more income. Secondly, the tax brackets are going to generally rise over in the future. So pay your taxes now while taxes are lower and you're in a lower tax bracket. Thirdly, the tax bracket, like I said, the government entitlements, taxes are going up in the future, kind of goes in with the second point. But fourth, and then I think this is the biggest one. When you're investing through a retirement plan, you're not paying the taxes on it. That's kind of the perk that everybody talks about. But what a lot of people don't know is you're not getting the tax benefits like the passive activity losses, bonus depreciation when you're investing within one of these retirement plans. I mean, if you want to do it, you can do a solo 401k. It would probably be a lot better than a self-directed IRA, by the way. But even at that point, you don't get the passive activity losses to play different games on your taxes today. And that's the big one. To me, it kind of breaks down two things. If you're not making more than $340,000 a year as a married person, you're in a lower tax bracket. You may not believe it, but you are, right? So you want to pay your taxes on it today. Don't defer it in a tax retirement account. Take it as cash, invest it as cash, and pay your taxes today. And then also, if you already have a retirement plan, any kind of qualified retirement plan, if you have less than a few $100,000 in it, just pull it out. I mean, that's nothing. What I try and do with clients is they're making $200,000 married file jointly. We take them up to that ceiling at $340,000 AGI because that's kind of the sweet spot where they can leak money out. So that person can take out like $140,000 every year without kind of hitting that $340,000 AGI level. And that's at that level because that's when the tax brackets kind of jump up from I think 24 to 32%. But it's this idea of strategically leaking out your retirement account. So you're strategically smoothing your AGI over the year. You don't want these highs and lows, kind of like how the Fed doesn't want, these highs and lows in the economy. They don't want bipolar economies, just like how you don't want bipolar income. You want it to be kind of level and always in like under that 340,000 ideally. Now we're the only people that make sense for retirement accounts are people who are making above that $340,000 mark, because if you were to take the money out of your retirement account, it's kind of painful, right? Because you're in a higher tax bracket. But still, most of those people, again, I would say it still probably makes sense. That's why, every situation is different, and try and talk to everybody to kind of see and kind of have them understand the strategy, right? Why? Well, the reason why is because when you pull the money out of a retirement plan and invest cash, and you use that cash to invest in syndications, you get the passive losses. And now, especially if you're doing real estate professional status, you can use those losses to drive your income down lower. Personally, I haven't paid taxes in like 4 or 5 years. Why? Because I have passive income, and passive income can be lowered by passive losses and bonus depreciation that I get from all these deals. I'm not using real estate professional status strategy. I don't need to. I don't have ordinary income, right? But a lot of people have a lot of ordinary income from their day jobs because they're starting to get into alternative assets and they don't have the passive income yet. So especially for those people, the passive activity losses may not help them. So I kind of probably confused everybody, but it is a bit of a personal situation, but generally most people should take the money out of their retirement accounts. Of course, deploy your home equity first because that's the laziest money, but the retirement money is next on the chopping block to deploy into alternative investments second.
Thank you, Lance, for that advice. That's one of the things, like we try to figure it out. What are we doing with all these 401k fund, right? And then, so Lance, I know you don't have the crystal ball, right? So now it's 2023. You see a lot of changes in the real estate market, and it kind of softened a little bit now. In your personal opinion, is it still a good time to invest in real estate, or do you recommend people just to wait, or what's your personal opinions on that?
I mean, at the end of the day, it's like, workforce housing, I think, is a very prudent investment. The fundamentals are there. In fact, what's happening now is, potentially the market is going to get better. Like the fundamentals are improving because people aren't really building to the demand. And then, I don't have a crystal ball. And what I mean I don't have a crystal ball is like the stocks, equity markets.
Mm-hmm.
I mean, next year, everybody's predicting a lot of pain, right? Because interest rates are going up and you don't really feel the pain until there's quite a big lag. If I was a gambling man, I'd say the stock market loses 20% next year, 2024. So then you ask the question, well, am I better off my money in real estate where it just kind of holds steady? Or am I ready to stomach that 20% loss next year and then write it back up? Or then take the money out and then put it in real estate, right? Like, so like, I mean, I'm not a financial planner. I don't sell traditional investments to make a commission. I also don't have a day job like how those guys do, right? Like, and I think that's where people have to build relationships with other passive investors to kind of piece this puzzle together based on their own personal investment philosophy. I believe in workforce housing. I believe in real investments that are tangible, that provide utility to the public, as opposed to, I don't like crypto personally. I like to invest in things that give me good tax benefits. And investing in real estate, apartment deals is kind of what I go very heavily on. Again, I'm an operator and syndicator, so I have to, right? That's also my business and livelihood too. So I have no stocks or paper assets. My net worth is pretty much 80-something% in syndication deals and workforce housing. And the other portion is life insurance. We do accredited investor banking, a little bit different twist on the infinite banking that's out there. But other than that, I don't believe in the stock market. And what I do know, working with so many people is it is impossible for people to get to like that $2-3 million threshold on net worth and above before your 45th, 50th birthday, unless you have more than 50% of your money in alternative investments. Sure, you want to dabble and you want to go $100,000, couple $100,000 in a syndication deal here and there. That's probably only like 5-10% of your net worth. Like I said, the people who are really growing their net worth are in like 30, 40, 50, 60% of alternative investments or more. Why? Because there's better returns there. You're not getting Wall Street stealing your money in fees and all these things. And secondly, like you're paying a lot less taxes doing it. So there's a lot less drag on your investment return there. And that's just like just data, right? That's just what happens. If you want to stay in the stock market and stay with traditional investments, stay with your nice guy financial planner, we know what's going to happen. You're going to make 6 to 8% maybe, and once in a while you'll bomb 10 to 30%, and you'll have to make a lot more to recoup that, of course. Or you can get off that roller coaster and get into prudent alternative investments that make a lot of sense. Just got to pick the right people, right?
Right. And Lance, you touch base a little bit. You mentioned a little bit about your about accredited investor banking. If you don't mind, can you share a little bit to our listener what that is?
Yeah, I mean, so infinite banking, I'm sure people hear about it a lot on podcasts. We originate it too for our clients. We also probably beat everybody on the pricing too. But the problem with infinite banking, or the way it's normally set up, since it's been set up since like the 90s, is you got to set it up with like a 4 or 5, 6 year, 7 year plan, or maybe even a 10-year plan, right? And a lot of our investors, kind of rule followers, and you make a plan, you got to hit it, right? Whether it's like putting in $100,000 a year, and people get stressed out about, well, I don't know if I can put $100,000 in 2026, 27, 28. So, and also a lot of people, especially newer investors, you may have a lot of money in your home equity, like 500 grand. And, it's hard to kind of divvy that over, several years or let alone 7 to 10 years. So the accredited investor banking that we do allows for like a one-time load. I kind of got the idea from like, a lot of these like exotic race cars nowadays, they're so powerful, right? Like 1,000 horsepower, it's crazy. Mm-hmm. And there's so much torque that you just fly off the line, but burn out your tires. So a lot of these, like, I think like where I got it from, like the Lamborghini Urus, the SUV, they have these quick launch functions where you just press a button and the computer just does all the math for you. And it feels how much traction you have with the ground. And the computer optimizes for the quickest launch without burning out, without skidding and losing traction, even when it's raining. It's crazy. But in a way, it's like for us, like we were able to create this one-time load, and that's it. You don't have to put any more. That's it. It's done. So it allows you for like the ultimate flexibility. Like I suppose you could probably do this every year, but the idea is, you do it one-time load, mm-hmm. and then maybe you do an infinite banking plan after, right? But it allows you to do that one-time load. So if you had that $500,000 lying around, or you inherited some money, or you're selling off a couple of rental properties that go into syndication deals, you can load up a big chunk, and then the next week you can take the money out and start that infinite banking concept, right? Where it's all compounding and you're making money 2 places, in the policy and in that syndication deal right away. So it's just another tool in the toolbox, right? Like, I think that's what's cool about this financial world is like, there's so many options. Oftentimes there's too much noise, right? Like, which ones do I do? Self-directed IRAs, qualified retirement mm-hmm. plan, so on case. What do I do? But, I think that's again, why you need to meet other purely passive accredited investors and kind of cut through the noise.
Got it. And then finally, I have one last question for you. Like you right now owns, $2 billion worth of asset. And for syndicators that listening to this podcast, and thank you for listening until this far, what advice do you have for them to scale up or grow up their business like you, or be successful like you?
Your syndicator business will live and die on you doing good deals. If you force a deal to happen, sure, you're kicking the can down the road. You may fail on the project a year from now, 2 years from now, 4 years from now. But as soon as you fail, your syndicator business will cave in. How many people I've talked to that started when I started, that they just happened to work with the wrong person, or they just picked the wrong deal. And right now they're sitting at home. It's like LeBron James. He's the only dude from that NBA class that still played basketball. How many guys who are just as good in high school that are like now 400 pounds haven't picked up a basketball in like 10, 20 years, or maybe not that long, but like 10, 15 years. And that's unfortunate, right? And that's what's hard about being like a general partner syndicator. Your reputation dies with one deal. In a way, you cannot fail. But like, I get it, right? Like when you're starting out, no broker's giving you any deals. You have to take what you can get. So that's like the entrepreneurial quantum, right? You have to take risks, but just know like your syndication business lives and dies on one deal.
Got it. So Lance, thank you so much for spending time with me today, especially early morning for you. So really appreciate you coming on to the podcast today to talk about your real estate journey, giving our listener a lot of tips and advices on the cash flows, passive investing, alternative investments, and asset classes out there, and also as our operators of to be successful like you as well. So if our listener wanted to find out or learn more about you, where can they go?
Yeah, they can go to, if they're a podcast listener, they can check out Simple Passive Cash Flow, Passive Real Estate Investing. We've been doing it since 2016. I started it, buying little rental properties, but obviously around like 2018, 19, we started definitely make it more targeted towards accredited investors and apartment deals and different type of syndications and the tax strategies and infinite banking, accredited investor banking. And then the website is simplepassivecashflow.com. If you guys want to reach out, you can reach out to team@simplepassivecashflow.com.
Len, thank you so much. It's a great honor to have you on our podcast. Thank you so much for your time.
Cool. Thanks.
And thank you for listening to our podcast today, brought to you by Bonavest Capital. We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bonavestcapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.